Hello everyone, and welcome back to Explain the Charts. Today, on November 21st, 2025, we are taking a deep dive into one of the market's most watched stocks, Amazon, ticker Amazon. The current landscape for Amazon is incredibly mixed, with a flurry of conflicting headlines that create a classic bull versus bear showdown. On one hand, the company has shown incredible fundamental strength, but on the other, recent market activity and analyst sentiment have introduced significant fear. Let's start by breaking down the recent news before we get into the charts. Just a few weeks ago, on November 10th, both The Motley Fool and USA Today reported that Amazon stock hit a new all-time high. This surge was fueled by a stellar third-quarter update, which saw total sales grow 13% year-over-year to over $180 billion. Amazon Web Services, or AWS, sales jumped an impressive 20%, and their advertising business grew even faster at 22%. Furthermore, a massive $38 billion deal with OpenAI to provide cloud services seemed to cement its leadership in the booming AI infrastructure space. Analysts from Yahoo Finance also noted that Amazon's custom AI chip business is rapidly scaling and has become a multi-billion-dollar venture. Based on this, Wall Street has set some very optimistic price targets, with an average of around $294 and a high of $340 per share. However, the narrative has shifted dramatically in the past couple of weeks. A Forbes article is now warning of a potential 30% downside risk for Amazon stock amid the AI bubble. This sentiment was amplified when Rothschild Redburn downgraded the stock, arguing that the massive capital investment required for generative AI infrastructure could actually be value-destructive. Adding to the uncertainty, Amazon recently issued $15 billion in bonds to fund business investments and capital expenditures. While this can be seen as a sign of aggressive growth, it also raises concerns about increasing debt and the high cost of competing in the AI arms race. As a result of these concerns, the stock has pulled back significantly from its recent highs, creating a pivotal moment for traders and investors. Now let's switch our focus to the charts to see how this news has translated into price action. Looking at the daily chart, we can clearly see the story playing out. There was a massive gap up on October 31st following their strong earnings report, where the stock jumped from a close of about $223 to an open over $250. This kicked off a powerful rally that culminated in that all-time high of $258.60 on November 3rd. This level at $258 is now the key psychological and technical resistance to watch on any major move back to the upside. But what followed was a swift and brutal reversal. The price has since fallen over 13%, erasing all the gains made after that initial earnings gap. Notice the series of large red candles starting around November 13th, which aligns perfectly with the timing of the analyst downgrades and news of the bond sale. The volume on these down days has been substantial, particularly on November 18th and 20th, indicating strong selling pressure and conviction from the bears. The price has sliced through several potential support areas and is now testing a critical level. Let's zoom in on this period from October onwards to get a better look. Here on the zoomed-in daily chart, you can really appreciate the velocity of both the move up and the subsequent collapse. This formation, a sharp rise followed by a sharp fall, is often called an inverse V reversal, and it's typically a very bearish pattern. It shows that the bullish enthusiasm was quickly overwhelmed by sellers. Currently, the price is hovering around the $217 mark. This is a crucial area because if we look back to mid-October, we can see the price found a bottom right here before its massive rally. The low on October 10th was $216, and the lows from yesterday and today are also in this same vicinity. This $216 to $217 zone has now become the most important short-term support level. A failure to hold this level could open the door for another significant leg down. Now, let's drill down to a shorter time frame to analyze the current trend. Switching over to the 1-hour chart for the past few days, the bearish trend is even clearer. We can see a distinct pattern of lower highs and lower lows. On November 18th, the stock gapped down from around $228, and that gap area will now serve as a formidable resistance zone. The price tried to rally on the 19th, but was firmly rejected just below $224, establishing another level of short-term resistance. Today, the price opened near $227 and sold off aggressively throughout the morning. This shows that sellers are still in firm control of the intraday trend. Any bounce from the current lows will likely face its first test at the $222 to $224 area. For the most immediate view, let's look at today's action on the 15-minute chart. The day started with heavy selling volume right from the open, driving the price down from $227 to the day's low of $216.74. Since hitting that low, the price has entered a period of consolidation, trading in a tight range for the past few hours. The volume has tapered off significantly during this consolidation phase. This can be interpreted in two ways. Bears might see this as a bear flag or a brief pause before the next wave of selling begins. Bulls, on the other hand, might hope that the selling pressure is exhausted and that this is the beginning of a base being built for a potential reversal. The direction of the break from this tight range will likely set the tone for the remainder of the trading day. So, let's go back to the daily chart and summarize what we've found and what to look for going forward. First, let's recap the key price levels. Major resistance is at the all-time high of $258.60, with more immediate resistance at the $224 level, and then the gap between $228 and $232. The critical, must-hold support level is the zone between $216 and $217. Below that, the next significant support might not appear until the lows from early August, around the $211 to $212 area. So, what's the outlook? Let's outline both the bullish and bearish scenarios. For the bullish case to play out, we need to see the $216 support level hold decisively. We'd want to see buyers step in with conviction, forming a clear bottoming pattern like a double bottom or an inverse head and shoulders on the shorter time frames. A strong bounce and a reclaim of the $224 resistance level would be the first sign that the bulls are regaining control. Given the strong underlying fundamentals of AWS and advertising, a bounce is certainly possible, but the technical damage has been severe. I'd put the probability of a sustained bullish reversal from here at about 40% in the near term. This likelihood would increase if we get positive market news or a strong close back above $224. Now for the bearish case, which the current momentum supports. If sellers continue to dominate and push the price to close below the $216 support level on the daily chart, it would be a very negative signal. This would confirm the breakdown and likely trigger a new wave of selling, with an initial target of around $211. A more significant drop, as suggested by the 30% downside risk article, would target the $180 range, which corresponds to lows seen back in April of this year. Given the current sentiment and the bearish reversal pattern, I believe there's a higher probability, around 60%, of seeing further downside or at least more consolidation at these lower levels before any meaningful recovery. Things to watch for in the coming days are Black Friday and Cyber Monday sales figures, which could provide a boost to the retail side of the business. Also, keep an eye on the broader market sentiment, especially concerning other big tech AI stocks. That's our in-depth analysis of Amazon stock. This is a complex situation where strong fundamentals are clashing with serious market concerns, creating a trader's paradise of volatility. Remember, this content is for informational purposes only and is not financial advice. You should always conduct your own research and analysis before making any investment decisions. Thank you for watching Explain the Charts, and don't forget to subscribe for more.